All right, let's jump right in. Today's explainer is zeroing in on the ultimate data-driven showdown between two absolute heavyweights of the financial world, lump sum investing versus dollar cost averaging. If you've ever found yourself sitting on a chunk of cash, just agonizing over what exactly to do with it, well, you are definitely in the right place. We've combed through 90 years of Vanguard research, a super fascinating 10-year Python data study, and multiple financial models to bring you the definitive breakdown.
So picture this scenario for a second. You just inherited $250,000, or maybe you sold a business or finally rolled over that old 401k. The money is just sitting right there in your account. What is your gut instinct telling you to do? Do you take a deep breath, close your eyes, and invest the whole thing today, or do you carefully, methodically trickle it into the market over the next 12 months? It's the classic windfall dilemma, and honestly, the path you choose can literally alter your lifetime wealth.
To get to the bottom of this, we've got to make sure we're on the same page with our definitions. Lump sum investing is, well, exactly what it sounds like. It means taking all of your available capital and deploying it into the market immediately, day one. The massive upside here is that you get maximum exposure to the market's long-term growth right out of the gate. But let's be real, the immediate risk, the thing that keeps us all up at night, is the absolute dread of terrible timing, like dropping all that cash right before a huge market crash.
And in the other corner, we have dollar cost averaging, or DCA for short. This is when you split your available capital into equal scheduled installments over a set period of time. So instead of buying all at once, you might invest an equal chunk on the first of every month for a year. Conventionally, we're all taught this is the safe way to play it, right? It smooths out market volatility because you're spreading out your entry prices. If the market takes a dive next month, hey, your scheduled installment just buys more shares at a discount.
Okay, let's dive into Section 1, the verdict, and what the data actually says about these two strategies.
Brace yourselves, because this statistic usually shocks a lot of cautious investors. According to a landmark Vanguard study, which literally tracked 90 years of U.S. stock data from 1926 all the way up to 2024, lump sum investing beats dollar cost averaging 68% of the time in a 100% stock portfolio. That is roughly 2/3 of all historical periods measured. So, mathematically speaking, if you have the cash, holding it back is statistically the losing bet.
Now, if we zoom in and look at a more modern condensed time frame, the numbers get even crazier. An independent 10-year Python data study tracked the S&P 500 from 2012 to 2022. And during that specific decade, a lump sum strategy mathematically dominated DCA an incredible 87.1% of the time. The numbers just overwhelmingly point in one single direction.
You might be thinking, well, surely if I'm in a safer, less volatile portfolio, DCA will take the lead, right? Actually, scratch that. It doesn't. When we look at Vanguard's breakdown across different asset allocations, even in a super conservative 100% bond allocation, lump sum mathematically wins 65% of the time, giving you an average outperformance of 1.7%. Move over to a 100% stock portfolio, and that outperformance jumps to an average 2.3% per year. Across the board, getting your money working faster just pays off.
Moving right along to Section 2, why lump sum actually wins. We're going to unpack the mechanics of market growth and the dreaded cash drag.
The foundational reason lump sum takes the crown is just the reality of how markets behave. From 1926 to 2024, the market has persistently trended upward over the long haul. Get this, 73% of those years had positive returns. And when it's positive, it goes big, averaging a 21% gain compared to an average 13% loss in the bad years. Because the market rises almost 3/4 of the time, delaying your entry means you are quite literally betting against the historical norm. You're statistically locking yourself out of likely gains. And this brings us to a huge, absolutely crucial concept, cash drag. When you dollar cost average, you aren't just carefully trickling money into the market. By definition, you are actively holding a large chunk of your wealth in cash or low-yielding accounts for months at a time. So, while your invested money is out there capturing historical growth, your uninvested money is suffering from cash drag. It's the silent killer. It's earning way less and almost certainly losing purchasing power to inflation. You're just keeping your money benched for longer than necessary.
To really put this into perspective, let's look at the real-world gap using Wealth Rewind data from 2000 to 2024. A $10,000 lump sum dropped into the S&P 500 in January 2000, ballooned by a multiplier of 6.37.
Meanwhile, if you took $30,000, 3 times the money, and DCA'd it monthly over that exact same 24-year period, it only yielded a 4.90 multiplier. The money that got in early and just stayed there completely smoked the money that steadily trickled in over the decades.
Let's map out how this builds over a lifetime using our $250,000 windfall example. If you lump sum today versus DCA over 12 months, by the end of year 1, both strategies are fully in the market. But because the lump sum had full exposure during that crucial first year, it almost certainly started year 2 with a higher baseline. Fast forward 30 years, compounding those slightly different starting lines, the lump sum finishes at roughly $1.9 million, beating the DCA strategy by a cool $70,000. That right there is the hidden 30-year cost of dollar cost averaging.
Which brings us to Section 3, the human element, and why in the world DCO still exists if the math is so overwhelmingly against it.
Seriously, if lump sum is so mathematically superior, why do financial advisors still recommend DCA all the time? Vanguard's own research team hit the nail on the head with this quote, "Dollar cost averaging just means taking risk later." Notice they didn't say it eliminates risk. You're simply kicking the can down the road, delaying the moment your entire portfolio is fully exposed. But the reason that delay matters so much brings us squarely into the psychology of investing.
So, the crucial point here is understanding our own human brains. There's this concept called loss aversion, famously studied by behavioral economist Daniel Kahneman. It shows that experiencing a financial loss feels roughly twice as psychologically agonizing as an equivalent gain feels good. If you lump sum 250 grand and the market drops 30% the next month, you're staring at a $75,000 paper loss. Mathematically, sure, it's just a temporary dip, but psychologically, it feels absolutely catastrophic.
And that right there is the true, hidden superpower of DCA. It acts as a behavioral guardrail. During the 2008 crash, investors who had just lump summed had a massive 28% probability of panic selling right at the bottom, locking in terrible losses. But investors who were actively DCAing their money during that same period, their panic selling probability dropped to just 17%. DCA is a psychological seatbelt that keeps anxious investors from abandoning their long-term plan. Because honestly, a perfect mathematical strategy is entirely useless if it just makes you panic and sell. Now, to be totally impartial, we do have to acknowledge the roughly 32% of the time that DCA actually does win on the spreadsheet. During massive, catastrophic market crashes, we're talking the 2008 financial crisis, the 70s bear market, the dot-com bubble, the 2020 pandemic crash, DCA mathematically crushes lump sum. By continuing to buy while the market is in free fall, you massively lower your average cost. But the massive catch here is that predicting exactly when those crashes will happen is virtually impossible, no matter how confident we humans like to act.
All right, Section 4, the hybrid compromise. Let's look at how we blend mathematical optimization with some much-needed emotional protection.
Behold the 50-50 strategy. It's the perfect middle ground. You can literally just split the difference. If you receive a windfall, take exactly half of it and invest it immediately as a lump sum. Bam, done. This immediately captures the market's historical upward trend and chops your cash drag in half. Then you take the remaining 50% and safely, comfortably dollar cost average it into the market over the next 6 to 12 months.
Now, what's really fascinating about this approach is the mathematical efficiency. By running this hybrid playbook, you capture roughly 85% of the lump sum's total mathematical advantage. You're only giving up a tiny sliver of expected return. But in exchange, you drop your risk of behavioral panic selling by a massive 7 percentage points. You are trading a fraction of a percent in theoretical returns for a massive safety net of psychological comfort. Honestly, it's a huge win.
So let's make this highly actionable. Here is a clear 3-step workflow for the next time you have a chunk of cash to invest. Step 1, pull out your emergency fund. Never, ever invest money you need to pay bills next month. Step 2, look in the mirror and honestly score your own panic risk. If a 15% drop tomorrow would ruin your whole month, do not lump sum everything. Step 3, pick your lane, lump sum, hybrid, or DCA, and write the rule down. Give yourself a schedule and stick to it, because making a choice and taking action always beats agonizing in cash.
Which brings us to our final thought for today's explainer. I really want you to ask yourself, math or emotion, which is going to drive your next investment? The spreadsheet makes it absolutely crystal clear that lump sum takes the crown. But as we've explored today, you're a human being, not a calculator. Thank you so much for joining me to break down this incredible data. Stay curious, trust the process, and I'll catch you in the next explainer.